Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, we're back here on YouTube and we're looking at the SPY, which is our proxy for the S&P 500. Now, I put a video out to my Patreon only video out a couple of weeks ago after the YouTube video talking about the possibility of going lower in the SPY and alternative counts to this being a flat. I put that out after we saw a three wave rally up with no confirmation of a third, with a fourth and fifth wave higher. So we started to look at this as an ABC, suspecting lower lows to come. Those lower lows have come, and now we're trading even lower in the pre-market. So on that note, time to update you guys here on YouTube as to what those new counts were. We're going to do that in a little while. First thing I want to talk about, because I feel that the narrative at the moment, if you're not careful, is going to rob you of a potential opportunity. Now, it's not necessarily here today, but it might not be too far off in the future. And not to fall into the trap of missing it. So, what do I mean by this? Well, I'm based in the UK, right? So, I'm a pounds pence person on a day-to-day basis, right? The dollar's dropping. It's down over 7% since the highs, more recent highs, which means every single asset in the United States costs me less in pounds pence terms today to purchase than it did before today, than it did yesterday. If this trend continues in the dollar over the shorter term or intermediate term, then everything in the future costs me less pounds pence terms to buy in the United States than it does now. Combine this with a sell-off in the stock market and things are getting doubly cheaper. I'm getting a double discount here for reinvestment into the United States. Okay, combine this with yields dropping, as we've seen across the Treasuries market, bond prices rallying. Okay, combine this with the Fed reducing the rate of QT from 25 billion a month to 5 billion a month. Combine this with an increasing money supply, which continues to strengthen month after month. And what I believe will be a surprising disappointment in economic data. The Fed has been reluctant to budge on rates. Okay, and one of the overriding arguments has been economic strength, that it's not necessary to cut rates because of economic strength. It's not necessary to cut rates because inflation's being stubborn. It's not breaking down. And I think those assumptions about economic strength, growth, increased growth, and also stronger inflation are all wrong. And I think there's some very disappointing news coming down the pipe. It might not be here tomorrow because there's always a lag in the financial markets, but it's coming. Now, if we look at the ISM report on business for manufacturing, this is the latest report. This is for March. We can see that we've gone from growing back to contracting. We only grew for a month. We went above the 50. I pointed it out that after a 26-month period of being suppressed, we were finally growing again. Well, that was very short-lived. Now we will return back above 50. I'm confident of that as the business cycle continue to expand for the next few years. But in the meantime, we've dropped back below to 49 with a 1.3% price swing. New orders plummeted 340 basis points. Okay, pretty significant. Contracting faster. Production down. Employment down. Supply deliveries down. Inventories up. Customer inventories up. Prices up. Okay, this here is what is leading to people to believe that there is significant inflation problems ahead, right? But I think that was front running. Those prices going up, and this business, the report on business, and that the business, if you read through the actual surveys themselves, there was an awful lot of front running, the tariffs, right? If you're going to purchase something before tariffs come in or after some tariffs come in, you're going to purchase it before. Hence the increase in inventories, which we've seen over the last few months, right? That has driven inflation to remain a little bit stickier, and also all that pre-purchasing to actually drive a little bit of economic growth. That's all going to stop now that the tariffs are in. And I think the actual data, with the dropping of new orders, the PMI dropping below, production declining, employment declining, you're going to see actual weak economic data coming out into the future. Now, we don't know exactly when, but I think it's coming. So if we've got the dollar here on the DXY breaking down and weakening, we've got yields dropping, bond market rallying, stock market selling off, Okay, we've got weaker economic data. QT coming to an end, M2 expanding, and potential Fed rate cuts and Fed intervention coming if the market keeps bleeding, that's going to be a massive investing opportunity in the United States. And it will only come when everyone's terrified and everyone's bearish and no one thinks the US is going to recover and everyone thinks it's doomed and it's 1929 all over again. All right, but that will actually be the perfect investing moment, and that's what I mean by opportunity. So forgive the rather brutish, boorish attitude, but fucking bring it on. Okay, if we're due a crash and it's going to happen, let's do it. Let's go. Let's bring it on. I can't wait. All right, keep your powder dry and get ready to take advantage of it. Okay, so that's my view on what's coming down the road from a macro point of view. Now, I'm not going to go any deeper than that, but we will look now at the counts. So the one we were working with was this, which was the flat pattern. And although it's not impossible, what I would point out is that the relationship between the length of the A and the length of the C, we were looking at coming down to a 1618 around this low. We were expecting a low to form. We got one. It wasn't a bottom, but it was a low. And we were at relatively extreme oversold conditions at the time. If we just bring that up. And we were also at pretty high levels of fear on the CNN Fear and Greed Index, right? But we haven't held those lows. We've swung lower again, rallied, and now in the pre-market we're trading lower again. So now that we've gone beyond that 1618, it's not impossible that the C extends deeper. It's just less likely to be correct. So I've had to replace this count with two other alternatives, which I now think are more likely. So on that note, we have the idea, since we were talking about the possibility of the top being in, let's talk about the top being in. So 5 waves complete into the high of February, 19th of February 2025, finishing with an ending diagonal. I've managed to wrangle an ending diagonal into here. It's still a bit of a struggle, but I've managed to account for it. 5 in the 1, back in the 3, 5 in the 2, just longer than the 1 in linear measurements and therefore just legal. Back in 3 and 4, and then 3 into 1, 3 into 2, 3 into 3, 3 into 4, and 3 into 5 to get a contracting ending diagonal in the 5th. This leads us to believe now then that this was 5 waves down in an A or ABC down into a W. Both are acceptable. The difference being that if it was a W, the Y doesn't have to have a stronger relationship with the A as the C typically does in an ABC, as these are breaking down into zigzags rather than 2 impulses. So the Y could extend, but it could also end at any moment. It could be significantly shorter. Okay, so if we were to suddenly get a rally from the low and 5 waves up and 3 waves back, we can probably point to a double zigzag structure. If we really brutally start to sell off, we can look at it as an ABC, and if we really break down, we can look at it as a 1 into a 2. Now those are all things which we can't decide yet. We'll have to wait and see what the price data does. But in the shorter term, a simple 3 wave move down lower could be expected. So if we said this is the length of the A, this is the B, and this is the next stop for the C at 512.86, if we were to do 1 to 1. If the B is also done, and we would channel down like this. Okay, something like that. Now there's also a myriad of possibilities, as there always are, that we're actually creating a more complicated correction. So we could have had a simple move down, but then we might get an expansive correction like this, doing multiple back tests before finally coming lower. None of that's clear at the moment. So in the meantime, what we can do is just put A here, B here. We can hide this, and then we can put an invalidation for this idea at the top of the B wave. So that wasn't B complete if we come back above there. And therefore this is 1 and 2. If we come back above that invalidation point, this was not 1 and 2. We are either going sideways in a broader correction, okay, or we've bottomed down here. So we have to wait and see what happens there. So let's put the price on 576.33. It looks like the market's going to open while I'm talking to you. I'm recording it slightly before because I'm on a bit of a tight schedule. I couldn't leave this video any later. So there's idea number 1, which is the top sim, and we're going to have a pretty, we're likely to have a sustained correction. And like I said, combined with everything else I said, opportunity. So just keep your ears open now. Like I said before, if we sell off and we head into lows, we want to be listening to the bears to tell us where the lows are, right? Because they're going to double down at the bottom. They're going to double down on their end of the world talk and their bearish talk right when we approach those lows. But that's what we want. Okay, like I said, if this is it, bring it on. Now, on the alternative idea, one leg up. One more leg up. I've managed to wrangle a triangle into this mess. Now you can see why at the top here I was so convinced that a flat pattern made sense. Right? 3 into 3 into 5. That's a pretty classic looking flat. Okay? But if it's 3 into 3, I found that we can break it like this. A, B, C, D, E, and a teeny tiny fifth just to stick its nose above the parapet. Get its face blowing off. And then fall down here. And this first leg down is either A, as we discussed, or W. This is X or B, and now we're doing either C or Y. I'm using the Y to accommodate an earlier finish. Because like I said, those zigzags don't have to be as related. That could be A, B, C down to here, for example. Now we've just got the open tick on here. A 5-4-4 spot 2-3. So it'd be interesting to see if we now rush to fill this gap. So the first thing I want to do is just get that gap on the chart, because that is a cleared gap on the day chart that's opened up. We might make our first port of call coming in to fill it before moving lower. I would not be surprised by that at all if that happens. Either way, we go WXY, we come lower. There's a couple of cut-offs here that I want to, or some levels that we need to pay attention to. 23.6 we've come through, typical retracement for a wave 4. 38.2 typical retracement for a wave 4. We're not at yet. That's 535 spot 30. And then the cutoff really is beyond the 50. Go beyond the 50, he's not really looking at a wave 4. And I think if you clear the entire prior wave 4 in the series of higher highs and higher lows, that's what I call the major pivot, because it is the last wave degree below this one where we had a higher low pivot form, and that was at 510 spot 28. Break that, you've broken the upward trend officially at larger wave degree. You've gone beyond all of the likely support levels for a wave 4. Go beyond that and we are most definitely, I think, into this topping pattern, and we're still in that C wave, and we could still be going deeper past the 100, past the 123.6, past the 61.8, down to the 50% and 61.8 retracement zones between 480 spot 67 and 449 spot 39, all the way down here. They become possibilities at that point if we firmly break that upward trend. So there's a lot of possibilities of going lower now, but if we do rally from here, we have to clear 576 spot 33 to have any bullish confidence at all now, because below that B wave pivot we're bearish. Okay then guys, that's really all I've got to say from a technical point of view. We've updated the counts, we've put them in, I haven't assigned probability regarding primary or alternate yet, I'm still considering that, but these are the targets we're looking at. So a lot of waffle there, so let's recap. The flat pattern is now the least likely because of how much deeper we've gone. This leaves either one more leg higher, which we are working on a double zigzag down, which will complete somewhere between where we are now and the 50% retracement of the wave 3 around 511 spot 22. A breach of 510 spot 28 cancels this count out beyond any reasonable probability, and we can discount it. Alternatively, the top's in and we are now in a nasty zigzag down, and the limits are anything from the 1-to-1 at 512 spot 86 all the way down to the 61.8 and the lower, which is around 449 spot 39. Depending on how aggressive this gets, it could be 1-2 as opposed to AB, and it could get really nasty. So we'll wait and see. Any bullish interpretation will only return once we get above 576 spot 33, and we still have to be on our guard against a potential new price extreme low sideways correction before heading lower. But we'd be looking for 5 up and 3 back out of here, right? Some kind of thing to build off of. We've noted today a gap on the open. We should always do that whenever the chart gaps down, because there's a high probability we have to come back in to fill the gap. We're trading higher so far. So we've discussed the macroeconomic point of view that I have at the moment, I think there's disappointing news coming. I think there's a lot of things to suggest that the stock market is going to be discounted, with a discounted dollar, with discounted yields, with QT slowing down, with potential Fed rate cuts accelerating, with M2 still expanding, with potentially disappointing or lower inflation data and lower business data coming through. All of these things point towards an increase in liquidity in the future once the Fed gets behind the wheel and starts drinking behind the wheel. We'll be fine at that point, but in the meantime we wait to see if the market sells off further, and we see it as a longer term opportunity as and when it does. So let's now wrap things up with the PCC and the VIX. The PCC 60 is still below the 250, still heading towards extreme complacency and bullishness over the longer term. We're not there yet, but something of note is if we look at a shorter term moving average like the 10, we can see that we actually have swept back in on the smaller time frame, smaller moving averages, back into extreme complacency and bullishness, and we've bounced from that level. We haven't been here for quite some time. The last time we got to these levels with the 10 moving average was all the way back in November 2021, roughly 1,180 days ago. So we did get into quite a complacent state of mind before this sell-off began, which was late January. And then the fear started to build up and we started to move lower in the stock market. It could be a smaller correction. Bigger corrections, more significant pullbacks tend to be marked by the 60 and the 250 coming down to this area rather than the 10 and the 20. So if we, like I've said, it's all about if we rally from here or not. Now let's come over and have a look at the VIX. The VIX has spiked a little bit today, but it has not gone above our proposed wave for low. Question mark that I put in here at 29.56. We can't really call that a wave for low anymore, so I'm not sure what to call that. No, that wouldn't be fair. I could just call it local spike because it may be exceeded. We gapped up in the VIX today. We're coming back down to fill that gap. We have not exceeded that level yet. We're still inside of this downward trend line. If we breach this local spike, we can now say market top in or deeper wave for, and wait for higher levels in the VIX to confirm with lower levels in the PCC, to confirm with the dollar continuing to sell off, to confirm with the stock market continuing to sell off. So the only other thing I would point to now, I mentioned them earlier, is if we just have a quick look at the bond market. This all points, if the bond market's calling the shots, right, then we are heading towards rate cuts. We've just got to be a bit patient. So let's have a look at the 10-year. So here's the 10-year today, right, and here's the DXY. DXY is the purple over the top. Now what can you see? Right, between these peaks, peak here, peak here, peak here. The DXY is leading the way down. And the yields are lagging slightly. The sell-off in the dollar began on the 27th. The sell-off in, or the increase in bond prices and therefore the drop in yields only really began on the 31st of March. So basically like a month later. And now yields are coming down as the dollar came down. So if yields continue to drop, dollar continues to weaken, stock market continues to weaken, volatility continues to increase, QT lessens, and people start to get really scared and panicky, we are getting our Fed pivot. It's coming. Can't say exactly when, but if we get the weaker economic data I expect as well, then it's coming, and then it's party time. Right, it's party time. It's time to get back into the United States proper, and I will thank Mr. Trump for having created me such a discount opportunity, especially as a Brit who's buying with a foreign currency into a weaker dollar. Thank you very much. We're not there yet, but I will gladly take it when it comes. Alright then guys, there's a brief update on the SPY. I hope it's useful to you. Let this be a lesson, because there's always new people coming to the channel, coming to the Discord and so on and so forth. Elliott Wave is a tool that we use to help analyse markets. It is not flawless because it's based on fallible human beings like myself who are doing their best to analyse the markets. The secret to being a successful trader and investor is to adapt to those market conditions as they occur and apply risk management to any decisions that we make. But we have to be willing, and then we have to be open-minded. So there you go, guys. I'll leave that there. If you like what you've seen and you're new to the channel, please subscribe, smash the like, hit the little bell notification icon to remain informed of any future video releases. And if you're interested in learning Elliott Wave yourself, getting access to a public Discord with lots of members discussing lots of subjects, as well as loads of educational videos, including the Elliott Wave series, exclusive live streams, lots of exclusive content which I only pull out to my patrons, and the dividend calendar, a stock rating system, and blah blah blah, please feel free to sign up to the Patreon. There's a link in the description box below. One more thing before I go. I'm going on holiday next week. This is with my family, and the kids are now off for 2 weeks during the Easter holidays off school, so likely to have less output and no output next week at all. So take care of yourselves. I'll be back with you as soon as I can. All the best. Bye bye.